Those protests are forcing leaders in Cyprus to revise the plan, and the fallout from the bloc's fifth and perhaps most controversial bailout are also being felt across the EU. Jack Barton explains how these moves could fan the flames of another financial crisis.
The markets and the euro tumbled on Monday as the EU digested the news that for the first time in a bailout, ordinary household savers could lose money. Even if Nicosia reworks the deal, policy experts say the damage is done.
After the 2008 experience, it was very important to keep the confidence of the small savers, and that has now been lost.
And that's why the deal is raising eyebrows among savers in much larger economies.
The message which goes to savers in Spain and Italy is if there is a rescue package, then they can be expected to pay a price as well.
Which raises the spectre of larger bank runs. And it wasn't just the euro and the markets that lost some of their roar on Monday. The cost of insuring the debt of even the top-ranking banks in Europe against the prospect of default has also risen sharply. Germany spent the day playing down its role in the deal targeting small savers.
The solution that was considered on Saturday morning, which also plans a levy on deposits below 100,000 euros, was not the creation of the German government.
Cyprus reportedly pushed the idea to lessen the impact on wealthy offshore clients who hold about 40% of the roughly 68 billion euros in the tiny country's banks.
Because then they thought maybe the large deposits will not come anymore. But I must say, from a European point of view, perhaps it's better if we don't have very large deposits flowing to small countries, which then create big problems elsewhere.
If nothing else, the rescue deal has highlighted just how fragile confidence in the Eurozone remains. Jack Barton, CCTV, Brussels.
For more on the crisis in Cyprus, we're joined by Kirkegaard, Senior Fellow at the Peterson Institute for International Economics. Welcome back. Good to have you here. This is a big one. Over the weekend, things were relatively quiet. Investors knew there was something that was likely to happen, but this caught a lot of people by surprise. A lot of investors, a lot of international folks, the market reaction, which we'll get to a little later, was not good. And I imagine for bank depositors, they're not happy either. What's wrong with this plan?
Well, I don't know it's something necessarily wrong with the plan, but the reality is that desperate times calls for desperate measures. No one likes to tax their bank depositors like what is being done in Cyprus, unless the alternative is that the Cypriot financial system collapses and takes the entire Cypriot economy with it, which is the alternative in this case.
So here are the two choices for our viewers to understand. Either A, the system collapses, specifically the banking system in Cyprus, or B, everyone's deposits get taxed by a certain percentage amount. So everyone loses. So obviously if you have more money in the bank, then you would be taxed at the same rate, but a higher dollar amount, correct?
Yes.
Who wins in this situation other than the fact that the system might go on if this plan gets approved?
Well, everybody wins in the sense that you avoid a much worse outcome. And the hidden benefit to Cyprus from this plan of action is that by taxing all deposits in the Cypriot banking system, you're actually also taxing a very substantial amount of foreign deposits in Cypriot banks, so that these are predominantly from Russia, perhaps amounting to as much as 15% of GDP. Now, that 15% of GDP in new extra tax revenue is money that the Cypriot government will not have to cut from government pensions, unemployment benefits, or other austerity measures.
A lot of people say that this could potentially be another Lehman moment. A vote is set to take place. The banks are closed right now. So if you want to avoid this, you couldn't take your money out today in any case. So it's either get the tax or get the collapse. Is this a Lehman moment for Cyprus and for Europe?
Well, I certainly think it is in a way for Cyprus. They're on the brink of something very bad happening to them. But I don't believe that it is a potential Lehman moment for the rest of Europe or for the world economy as a whole.
But the ECB has a very big role. We were talking about this earlier before we went on the air. The ECB wants this. I mean, they said take this deal or leave it, right?
Yeah, I mean, the ECB and the Germans and the other Europeans and the IMF does not want to basically give Cyprus 100% of GDP in loans. So the Cypriots have had to come up with some new source of tax revenue, and they have basically gone where the money is, which is the banks. So everybody wants this. But again, I want to come back to the starting premise. This is sort of, either it's a terrible situation or a catastrophic situation.
This is not the first time there's been a bailout. This is now the fourth, fifth bailout we're talking about. Why did all the other bailouts not work? Or were they ever intended to work? Or was it really just to buy time?
Well, I don't think that one can say that the other bailouts haven't worked. Ireland issued a new 10-year bond a couple of weeks ago. It is clear that the Greek bailout has not quite worked yet. But the reality is that the different countries in Europe have different problems. The Cypriot economy...
This is the first time they're going to tax bank deposits. I mean, has it ever been in the history of any banking system in the world that there's been a bank tax? I mean, I'm not aware of any.
I mean, you've had a number of those situations. You had it actually in Italy in the early 1990s, not to the tune of 10%. But this has been a way for governments to raise, emergency tax revenue in history. But again, the point is that the Cypriot economic situation is quite different from the situation in other euro area countries because of the tremendous size of the Cypriot banking system. It's 800% of GDP, which is another way of saying that if the Cypriot banks have a problem, then the Cypriot government has a problem because it won't be able to bail out these banks.
So over the next 24 to 48 hours, the markets are nervous right now. Do we worry about this deal or do we not?
No, I think we should worry about this deal because, as you say, there will have to be a vote in the Cypriot parliament about this. But I think the reality is that we're sort of in between the first and the second TARP vote here in the United States, where, initially the US Congress rejected the bailout here, and then the markets responded very negatively. Well, that's the same thing that's going to happen in Cyprus, where eventually Cypriot parliamentarians are going to realize that, unfortunately, they're going to have to swallow hard and accept this deal in perhaps a slightly altered version or face an absolute economic calamity.
Thank you for your analysis, Jacob Kirkegaard from the Peterson Institute of International Economics.